Student debt isn't just a string of numbers in your banking app. It is a set of chains preventing you from buying your first home, starting a family, or finally quitting that job you absolutely loathe. You stare at a balance of $40,000 and think you'll be paying this off until you're 65. But what if I told you there are mathematical loopholes that allow you to wipe out this debt twice as fast without waiting for a government handout? Today, I'm giving you a comprehensive roadmap on how to hack the system, calculate interest in your favor, and turn your negative net worth into a foundation for generational wealth. You've likely noticed the world has shifted. Inflation is eating away at your purchasing power, and the Federal Reserve is keeping interest rates high. This means your debts are getting heavier, and every dollar you hand over to the bank in interest for your compound interest. Most people just make the minimum payment and hope for a miracle or the next debt forgiveness program promised by politicians before an election. But relying on the government for your personal finances is a losing strategy. If you want to be free, you must take control of the wheel right now, in 2026, while the market still offers you leverage. Let's break down how this machinery actually works. Banks rely on your financial illiteracy. When you make a standard payment, the vast majority of it goes toward covering the interest, not the principal amount you actually borrowed. This is called amortization. It's like trying to bail water out of a boat with a leaky bucket. Your mission is to redirect the force of your money directly into the root of the problem. Think of your debt as a fire. The minimum payment is just a little bit of water to keep the house from burning down completely. But to extinguish the flames, you need a high-pressure stream aimed at the center. That center is your principal. Every extra dollar you contribute above the minimum immediately shrinks the base upon which tomorrow's interest is calculated. This is the magic of reverse compound interest. The first step in our master plan is a total audit. You have to know the enemy's face. List every single loan you have, federal, private, subsidized, and unsubsidized. Look at the interest rate for each one. If you have loans at 7 or 8%, you are in the red zone. Next, choose your weapon, the Snowball Method versus the avalanche method. The avalanche method dictates that you pay off the loan with the highest interest rate first. Mathematically, this is the most efficient. However, if you need a psychological win to keep your momentum, try the Snowball Method. Pay off the smallest balance first. This triggers a dopamine hit and gives you a sense of command over your life. Now, let's talk about a strategy that 90% of borrowers ignore: refinancing. If your credit score has improved since you graduated, you can go to a private lender and ask for a lower rate. For example, moving from 7% down to 4.5% can save you tens of thousands of dollars over a 10-year period. But a word of caution: when you refinance a federal loan into a private one, you lose government protections like income-driven repayment plans or deferment options. You are trading a safety net for a lower price. Next is the bi-weekly payment hack. Instead of paying once a month, split your monthly payment in half and pay every 2 weeks. Since there are 52 weeks in a year, you will end up making 26 half payments. That equals 13 full payments a year instead of 12. You won't even feel the difference in your lifestyle, but this simple trick can shave years off your loan term and save you thousands in interest. It is pure, unadulterated arithmetic working in your favor. Let's look at a concrete example. Imagine you have a debt of $30,000 at 6% interest for a 10-year term. Your monthly payment is roughly $333. Over the life of that loan, you will pay the bank nearly $10,000 just in interest. But if you add just $100 to your monthly payment, you won't be paying for 10 years. You'll be done in 6 years and 3 months. You'll save over $4,000 in interest. That is money you are literally taking out of the banker's pocket and putting back into yours. Furthermore, we must utilize tax advantages. In the United States, you can deduct up to $2,500 of student loan interest from your taxable income every year. This lowers your tax bill and essentially gets you a refund from Uncle Sam. Do not use that refund for a new gaming console or a vacation. Pump it immediately back into the principal of your loan. This is how you create a feedback loop of debt destruction. But I must warn you about the pitfalls. The biggest mistake is lifestyle creep. As soon as you start earning more, there is a massive temptation to lease a new car or move into a luxury apartment. Stop. Until your debt is gone, you don't truly own your income. You are just a middleman for your creditors. Also, be wary of debt consolidation. Sometimes combining multiple loans into one gives you psychological relief, but actually raises your weighted average interest rate. Always calculate the total cost of the loan, not just the monthly payment. Another risk is the lack of an emergency fund. If you throw every spare cent at your debt and your car breaks down, you'll end up using a credit card at 24% interest. That is a total disaster. First, set aside at least $1,500 for emergencies, and only then begin your aggressive attack on the student debt. Wealth is not about luck. It is about boring discipline and understanding where every single cent goes. Student loans are a temporary hurdle, not a life sentence. If you start following this plan today, 5 years from now, you will thank yourself for not giving up and not waiting for outside help. You are stronger than your debts, and you are capable of building a life where money works for you rather than you working for it. If you want to learn how to transition from killing debt to building a dividend portfolio that generates passive income, subscribe to this channel. We break down finance without the fluff or the hype. In the next video, I will show you how to build a portfolio that pays you $500 a month within just 3 years. Start moving right now. Your future self is counting on you. Which of these strategies are you going to implement first? Would you like me to help you calculate a specific payoff plan based on your current balance and interest rates?